Welcome to the Retirement Compass radio show. Now, when it comes to your hard-earned financial future, there's a big difference between accumulating a bucket of money and knowing how to actually build a plan that can withstand real-world shockwaves. We got a full house today on the Retirement Compass. Joining me to help guide through the financial fog, Jeff Gove, partner and financial advisor, Tim Kulhanek, co-founder and financial advisor, and Zach Vancas, financial advisor. I feel like we have almost all of Stonebridge Wealth Systems, but I know you guys have so many other incredible members of your team. Thank you so much for taking time to jump on today and talk some retirement to our friends in Nebraska.
We like talking to our friends. That's what we do.
All right, guys, we'll just jump right into it here. Tim, I want to start things off with you. True financial security isn't just about what goes right. It's about how you recover when life completely blindsides you, and whether it's sudden health care crisis, a late career job loss, market crashes, like right on the doorstep of retirement or right after retirement. It can be an absolutely devastating impact if you're unprotected. Let's jump right into some financial mishaps. And what's a way that a family right now can start to build true resilience in a plan?
I would say not being dictated to on when you start to plan by an arbitrary age. You know, a lot of the financial world has now evolved to where everything is based off, well, at this age, you're supposed to have this much saved, or at this age, you're supposed to be allocated this way. And, you know, one of the reasons why Zach's sitting next to us is because he, as like, I think, what were you, 16 when you first called us? Something like that? Like, he was, now that he's 17, it's different, but I'm joking.
There's a segment on being young later on in the show, actually.
Yeah,
I'll take that one.
He's an old married man now.
Yeah.
So, you still getting along okay?
So far, yeah.
Okay, good.
Almost 2 months in.
Good. You guys are going to make it a long time. So, good start. But he contacted us because he called Dave Ramsey, and Dave was like, "You did what now?" You know, no, that didn't happen. But he was a follower, an acolyte, a disciple of the Ramsey way in some senses. And really what that means is he actually paid attention to his finances at an early stage and wanted to make sure that he was planning ahead so that way, you know, someday he could live like no one else. Is that the way Dave puts it, right? Live like no one else, so someday you can live like no one else. And like we kind of joke about it sometimes because it sounds cliche, but it's not a cliche when the rubber hits the road and you find yourself, you know, Jeff had somebody, we like to tell stories on the show, this several years ago. The guy had already retired, pulled Social Security, then called Jeff and came in and sat down with him and said, "Well, how am I looking for retirement? Because I already did it," you know? And well, no, we don't want to do that. We want to make sure that we're saving the right amount so we don't feel like we have to play catch up later on and find ourselves in a vulnerable position where we feel like we're forced to work till we're in our 70s or something like that because, you know, life, you know, it could be fragile. We don't know how long we're going to get. We want to make sure that we're putting ourselves in a position to be successful early on.
You know, Jeff, Tim just mentioned that Zach got married recently. I'm sure in your many, many years in the business, you've encountered a lot of people on the other end, right? People that didn't just get married, but people that unfortunately got divorced for one reason or another. How is that part of, you know, obviously a big disruptor, but how is that part of something that you can help people plan? I know you're not a divorce attorney, but in terms of the financial aspect of things, is moving on into that next chapter of life.
Yeah, I mean, it comes down to having a plan, you know. I mean, none of us plan for divorce. You know, when you get married, it's not like, well, if it works out, it works out. If it doesn't, it doesn't. But, you know, Tim talked about Dave Ramsey. A lot of it comes down to living within your means, having a plan. You know, once let's say you do get a divorce and the marriage ends and you go your separate ways, you still have to plan. You know, retirement could still be in the future for you, or should be in the future for you. So it's just going to look different. For a divorced couple, you know, there are still options available to you when it comes to Social Security. So you need to know what those options are. You know, who gets the 401k? Do you have Roth IRAs? You know, money that you saved in the bank, living, you know, who gets the house? Where are you going to live? All these things, you got to put together a plan, you know, so you can still retire the way that you want to. But a lot changes.
Zach, are you still married now? I know earlier in the segment you were. I just want to check. I want a status update. Zach, are you still good?
As far as I'm aware,
your phone there,
I
Zach.
I don't have any texts or missed calls or anything or emails. I haven't been served, so far we're good.
Well, okay, so just thinking about the wedding thing, and not to make this about me, but when I got married a few years ago, the week before we got married, which was the biggest expense I had ever had in my entire life, was our wedding. The week before, our AC went out. The week after, the hot water heater started spraying water all over the garage while we had friends still in town for the wedding from out of the country. And, you know, it's not divorce. That was our wedding, but that was, you know, one of the curveballs that life throws at you. And, you know, a lot of times that there's people, okay, something like that happens, and now you're on a payment plan for the AC unit, or you're trying to figure things out. I mean, curveballs like that absolutely can rattle somebody. Hopefully that didn't happen on your wedding week just a little bit ago, Zach.
Yeah, no, not yet. Haven't had any ACs blow up. We did have to have somebody come take a look at the AC, but that was only a couple $100, so we're good so far. But it is like a 12-year-old unit, so fingers crossed. But yeah, the example you just gave there, Mike, is a perfect example of people look at their finances so reactionarily. Like it's not about planning. It's about, okay, well, I can make my monthly payments. I make, however many bucks a month. I'm going to spend that much, maybe put a few dollars a month away just because grandma told me to. And then I'll deal with it when I get there, right? You had whatever budget for the wedding, and most people just go, okay, I have $10,000 saved. What am I going to spend on the wedding? 10. Or let's be honest, 11, right? Just a little more.
Yeah.
And, life's consistent inconsistencies, they're always going to be there. And if you live just exactly to that monthly budget in a perfect situation, it doesn't take anything to knock you off the course. That's why having, a 6-month emergency fund is so vital. That's why having these contingency plans in place, because you can't go through life with no buffer, with no protection, with no plan, because, life's the thing that happens to you while you're trying to plan. So not having those contingencies ready, I mean, you're just going to react to everything.
If you're listening right now and maybe you had a situation like mine, or maybe it's something even more significant, an unexpected market downturn took a big chunk out of your hard-earned life savings, a sudden life event, maybe it's a healthcare emergency that, we know here in this country can be very, very costly. The solution to planning for that curveball, that fumble that life has thrown at you, is a comprehensive, stress-tested strategy designed to insulate your wealth. If you want to take care of your future, take control of your future, schedule a complimentary strategy appointment with the team. Stonebridge Wealth Systems, available right now at 866-295-5146. That's 866-295-5146, an easy, no pressure phone call just to get you started to protect what you've spent a lifetime building. 866-295-5146. Tim, we threw out a couple examples. What are some of the other examples? Maybe a medical event. We touched on divorce, but what are some other examples of things that oftentimes derails, well planned out retirement plans?
Well, the thing it is, most people, when they think about a well-planned-out retirement plan, they're thinking about, well, I'm maxing my 401k, or I'm getting the full match of my 401k, or I'm doing the Roth. I think I'm doing everything right. But sometimes, especially with men, this is a problem where we have this, until we have something happen in our minds, it's like, well, yeah, I want to focus on saving money. I don't want to focus on, if something happened to me, nothing's going to happen to me. I read all the stories about the people my age that something happens to, they get sick, they become disabled, something happens to the car accident. But that's somebody else. For some reason, this cognitive dissonance we have that it's everything but me. I am the one that has this force field. So I looked this up, Mike. According to Ernst & Young, a recent study that they did, this is within the last year, the retirement savings gap by 2030. So in other words, think about it this way. The amount of money that people planning for retirement need to have saved versus what they actually have saved, and the gap between those two, the delta, $240 trillion. So we are not really in a great place right now as far as being prepared for retirement. A lot of the people might be, but that's because you tend to hang out with people that are also responsible, and people who are listening to this show are probably people who are pretty into their finances, right? And they're doing, they're diligently saving. but a lot are underinsured as well. So when these things happen, life's consistent inconsistencies. When you find out that you're going to have to take some time off of work to deal with either health issue, maybe for you, maybe for a loved one, whether that's, we've talked on the show before about all the unpaid caregivers in America and how it costs billions of dollars every single year. If you have insufficient emergency funds, savings, life insurance, disability insurance, if your company offers disability, group disability, you're not taking it, you're exposing your family to potential financial disaster, and it really isn't that expensive to take care of these things. The insurance protection gap is $160 trillion expected to be by 2030. So making sure you're being responsible, like we're big believers, this goes to the Dave Ramsey thing, like if you're young, and when I say young, like you're still working, you're 55 to 60 and below, like you can get really inexpensive term coverage that's like $1 million or more, and it's going to cost you like pennies on the dollar. It's super, super cheap. And you owe it to your family to make sure you're checking those boxes. So you're not just focused on the 401k, but also on making sure that if something happens to you, you don't get up tomorrow, the people that depend on you are going to be okay.
When life hits you hard, a bulletproof financial defense is what you need to keep your retirement goals on track. And we talked a lot about bad news. A lot of times there's good news too, right? There's good surprises. You and your spouse, you're expecting, all of a sudden you find out it's twins. Maybe it's more than that. Maybe it's triplets. That's great news, but also that financially, maybe not the best news for you. To see where your current vulnerabilities might be in your plan, especially when things that we didn't even really get into, market risk, are part of the equation, head over to StonebridgeRiskQuiz.com. You can take that risk assessment quiz and meet with the team at Stonebridge Financial at one of the 4 locations in Nebraska. Begin building your own personalized financial roadmap. Give them a call at 866-295-5146, or you can always go online at stonebridgeiwm.com, 866-295-5146. We'll be right back.
Did you ever think your retirement would be shared with our government? It's true. Your traditional 401k, IRA, pension, or similar retirement accounts are like a partnership with the IRS. Simply put, they want their tax dollars, and you have them. With our latest tax calculator, you can plug in your own numbers while sitting at home. To find out what your future tax liability could be, scan the QR code or go to stonebridgetaxbill.com.
Welcome back to the Retirement Compass radio show. I'm Mike Bauer, joined by Jeff Gove, partner and financial advisor, Tim Kulhanek, co-founder and financial advisor, and Zach Vancas, financial advisor at Stonebridge Wealth Systems. Tim, I want to piggyback off something you brought up a little bit earlier in the show, and you had talked about the protection gap with life insurance. You had thrown out there, 55 years young, there's some term coverage options. I want to follow up on that a little bit about life insurance as not just as something that pays off when you pass away, but maybe something that people can use as an investment tool as well.
Yeah, I mean, when used properly, life insurance can be one of the most flexible tools that the financial industry has ever created. And, the rules have changed over the years, but the great thing with life insurance is as the rules have changed, any of those changes, the people who bought policies prior to the change have always been grandfathered in to the parameters and rules that were in existence at the time they purchased the policy. Well, under, I think it was the Health Insurance Portability Act or whatever, from the late 90s, HIPAA as we know it, right? They created a provision within the tax code that allows you to use your death benefit. You essentially are able to become the beneficiary of your life insurance policy. And this would be a permanent policy, not a term policy like I was talking about earlier. You essentially have an environment where you can become the beneficiary while you're living. Because like you said, usually like the downside about life insurance is you have to die for it to pay off. But what if you didn't, right? And like Jeff, you were talking during the break and you're like, I read a book and somebody said, hey, if life insurance is free, how much of it would you want? I said, well, I'd want all of it, right? So we know that there's like a lot of value in life insurance. And Ed Slott says it's the only way that you can legally print money. One of the 2 biggest loopholes in the U.S. tax code, CPA Slot says it's either the annual estate tax, the gift exemption, annual exclusion, I should say, or it's life insurance because you can put after-tax dollars into it and it leverages them up. Again, might have like a 20-to-1 type of initial or 30-to-1 type of payoff day one, and it's all tax-free. And so when we think about one of the biggest things, like if you went to Google and just did an analysis on what is the most common searches right now, it's things surrounding taxes and estate planning, income-related monthly adjustment amounts for Medicare beneficiaries, the future of Social Security, and how do I make sure that I keep my estate intact and keep my family together at the same time. And the reality is, and we'll talk about this in a future segment, but when you're talking about especially like business owners, farmers, I put them in that category, folks in the ag industry, a lot of what they own isn't, it's on paper, but it's not like the Benjamins, right? It's not liquid. It's not something you can go and just take a withdrawal from because it could be dirt. But where it gets complicated is when you're trying to separate that and, heirs are inheriting land as joint tenants, it can get really, really uncomfortable because not everybody wants to be a, 25 or 50% joint owner of every speck of dirt of that farm with their siblings. Or what we see happen here in Nebraska is, best of intentions, family wants to keep the dirt in the family. And so they put it in a trust and say, no, you got to keep this together. And usually it only lasts about one generation because there's three reasons why people will do about anything: because they love someone, because they love something, or they love the economic benefit that something gives them. Well, when mom and dad pass away, the someone is gone. So they hold onto the farm because it's a nostalgic type of emotional type of anchor to the someone. But that's the thing, right? Maybe they grew up there. But by the time it gets to the next generation, that feeling is really gone. A lot of times those kids didn't grow up there. And if you have joint ownership between like 15 different cousins, one of them's going to want out. One of them's going to be like, okay, the yield on this is trash. Like I'm netting 1.8% and I want to sell today. And there's something called a partition sale, and it can get, again, it ends up in court. And, when that happens, the only person that wins or persons that win is who, Zach?
The attorneys.
The attorneys, right? Because you're litigating over principle and this just gets a mess. So why does that tie to life insurance? Because one of the greatest tools when it comes to estate planning is life insurance, because it provides you an inexpensive way to essentially be able to buy out other people. If there's 4 kids and there's 4 quarters, but only 1 or 2 of them are farming, like if they had life insurance on mom or dad, for example, now they don't have to worry about going to the bank and getting a loan. What if credit's frozen? What if it's tough to get a loan? What if, they're not able to borrow the right amount that they need? What if the 4 quarters are joint ownership and not partitioned from the beginning? If you do partition them, the problem with that is one's irrigated and it's flat and the other is hilly and it's like not great soil and it's further away from the home. Like there's complications. Life insurance can be a very flexible tool. You could potentially use it to pay for your health care later on. You can use it for estate planning purposes. So people often overlook the utility of life insurance. And I'm telling you that coverage gap, that insurance gap, it needs to be addressed. And it's one of the main things we're doing with folks when it comes to their estate plans today.
And when you broke out the coverage gap, it was in the trillions with a big T, the trillions, right?
Yeah, but like it was by 2030, but by 2050, it's supposed to be like 250 trillion. It's insane. That's in the United States alone. So it's a problem and it needs to be addressed. That's why we're talking about it.
I legitimately would have to Google what's after a trillion. I'd have to find out what the next, I know millions, billions, trillions. So if we
Zach
finally
knows.
get there, what's that?
It's bajillion.
Thank you.
Is that technical or is that just colloquial?
One other, like
We'll
Tim
leave
said,
it open to
like Tim
interpretation.
said, it is a tool. Life insurance is a tool, but another way that it's used is, we can try to grow our net worth. If we have everything that we need, that we're going to be able to live the way that we want to. So now we're to that estate plan. We want to try to grow our net worth. Another option using life insurance is we can buy our net worth, right, for estate planning. So you can try to grow it. Say you have $2 million and you want it to become, over time, I want it to be $5 million, or I just want it to be as high as I can, taking, this set amount of risk. Or we could take some of that money and you buy, $5 million in life insurance. So we don't have to take the risk to try to grow it to be that number in the future. We can get that number today. So then if, heaven forbid, you're hit by a truck and you die, you didn't have an opportunity to grow that money, you get that and it's tax-free to your kids. I had a gal in my office just yesterday who has a couple $100,000 in CDs that she's going to leave to charity. She doesn't need the money. All of her net worth is essentially going to go to her church or to the university. And what she was contemplating is, do I just give this money now? She's like, there's nothing specific I want to give to right now. There's no campaign or anything like that. I'm okay with just leaving it when I'm gone. So what we're looking at is a single premium life insurance policy that's going to double that. So, she puts in 200, the death benefit's going to be 400, and it's going to be that day one. In addition to that, she still has access to that cash. So she changes her mind in the future, or her financial plan changes, she can get in there and access that cash still, and it's still growing for her, but it's going to give her options, and we're leveraging those dollars. So we're not just giving them 200, now we're giving them 400,000. It's even more powerful if that money was going to go to your kids, because the charity would have received that money tax-free anyway. But your kids, because it's life insurance, they'll receive that death benefit tax-free. So lots of different uses, but don't wait. If life insurance is important to you, or, buying your estate, if that's something that sounds good to you, don't wait, because you have to qualify, right? It is life insurance. Same with long-term care. Don't wait until something happens to make the buying decision, because unfortunately it's not just your decision. The insurance company gets a say in this as well.
You are listening to Tim, Zach, and Jeff. We got the whole crew here. Stonebridge Wealth Systems, the Retirement Wealth Compass. You can jump in on on this conversation by giving them a call and figure out what you're looking at in terms of not just estate planning, but insurance as a potential investment option for you as well. You can give them a call at 866-295-5146. That's 866-295-5146, and a great resource for you. If you want to see if your estate and inheritance plan is truly ready for the next generation, go to stonebridgelegacy.net. That's stonebridgelegacy.net. There's a legacy and estate planning readiness quiz right there. It's very easy to fill out, and just go right on there. And then, of course, from there, you can get in and schedule that first appointment and meet with the team at any one of the locations for Stonebridge Wealth Systems. Zach, I want to ask you before we wrap up here, as we're talking about life insurance, Tim recently said that he was joking about how young you are, but for somebody that in the younger years, what's different about getting a life insurance policy in those working years as opposed to in your retirement years?
Yeah, when you're in the retirement years, as we've talked about, life insurance can be a big tax play. It can be an investment plan away. Estate planning is obviously the number one goal there. But when you're in your working years, you've got a family likely that's reliant on you. We say when it comes to life insurance, there's needs and wants. Wants, maybe I want to give my family $5 million when I pass away. Needs are, if I were to pass away, my now wife cannot afford to pay the mortgage. That's a need, right? Like that I can't leave a young family worse off because I had passed away, right? If somebody's reliant on you in any way whatsoever, that's where life insurance comes in. Of you cannot leave them destitute, because, you got unlucky and got hit by a bus. Like Tim said earlier in the show, men especially all think, well, that's not going to happen to me, right? You see all the statistics about people passing away, this, that, the other. Well, that can't happen to me. I'm invincible. I'm healthy. I'm great, right? There's no point in me getting life insurance because I'm not going to die, said everyone who passed away young, right? So if anyone is reliant on you, that's where, I argue that it's more of a need than just a want at that point to provide your family with that coverage.
Well, whether it's a need or a want, to start the conversation with the folks at Stonebridge today, you can give them a call at 866-295-5146. Set up a complimentary, no risk, no obligation first visit with them. And as I mentioned just a little bit ago, stonebridgelegacy.net is a really cool readiness quiz that they've set up for legacy and estate planning specifically. You can always go online and explore the common sense process that Stonebridge, that has prided themselves on and built over the years at stonebridgeiwm.com. That's stonebridgeiwm.com, or just pick up the phone, give a call, 866-295-5146. We'll be back right after this on the Retirement Compass Radio Show.
Hi, I'm Jeremy Gove with Stonebridge Wealth Systems. Are you taking too much risk with your retirement or not enough? Most people really aren't sure. That's why we created the Stonebridge Risk Quiz. In just a few minutes, it helps you discover your personal risk tolerance. Your score could reveal why your investments sometimes feel too aggressive or maybe too conservative. It's quick, simple, and eye-opening. Scan the QR code or visit stonebridgeriskquiz.com to see if your money matches your mindset.
Welcome back to a special spotlight segment of the Retirement Compass. I'm Mike Bauer. We've got Jeff Gove, Tim Kulhanek, and Zach Vancas in the house today. In Stonebridge, speaking of the house, they got 4 big houses that you can stop by, meet with somebody in person. Offices in Grand Island, Kearney, Omaha, and Lincoln. And Stonebridge serves families from all walks of life across Nebraska, but a tremendous number of farmers, ranchers, and agribusiness owners are listening right now. And Jeff, you know, for a family farm, retirement isn't just handing in a 2-week notice to a corporate boss. You know, you don't get the golden watch, all that stuff. One of the biggest hurdles you help folks navigate is the concept of fair versus equal when it comes to the next generation. Why is that such a minefield for ag families?
Yeah, for most farming families, if you have more than one child, we see farmers that are, maybe you have 3 kids and one of the sons is on the farm, or it could be a daughter, is on the farm helping out, and the plan is that they're going to take it over. But we've got 2 other kids that, or have moved out of state, for example. How do we navigate equalizing the estate? So it doesn't have to be equal. I mean, equal isn't always fair. But how do we make it as fair or as equal as you want it to be? We talked about life insurance early in the show. That's a good tool. The other issue that a lot of farmers face is, how do I transition out? I want my son to take over the farm, but how do I do that efficiently? I've got millions of dollars of equipment that if I sell, I'm going to recapture all of the depreciation that I took on this. I'm going to pay income tax on it. Do I give them the land? Do I rent them the land? How do I navigate this? How do I put them in a position where they can be successful? Because it's very, very difficult and probably close to impossible for an individual to just jump into farming today. If you had to buy equipment, you didn't have land, or you're renting land, you got $1 million in debt plus just for the equipment. It's very difficult, especially with crop prices today. So how do I put this individual in a position where they could be successful, where they can make money to feed their family, they're not taking too much risk? But it all comes down to a plan. If you have a few years, you can put together a really good plan where, from an income tax perspective, maybe you've been pushing expenses or taking expenses, pushing income. Well, that last year, you're not going to have expenses, but you might have a bunch of income. If you have some time, some years in between, where you can start to put together a plan of how do I efficiently pay tax on this money so I don't get just destroyed in tax on that last year, you can put together a plan to help limit that as much as possible.
You're listening to Jeff Gove, and Jeff, I want to bring Tim in here briefly, because Tim, I know we talk a lot about 401ks and Roth IRAs and a lot of this, where it's money out there in an account, but for a lot of people that work on the farm, that grew up on the farm, that it's the family business, that's not the case.
I mean, sometimes it is. One of the things that we've helped a lot of our ag clients do is develop financial plans that include their own personal kind of private 401k. It's called an individual or solo 401k. And sometimes those expand to include a profit sharing. Sometimes those expand further to include a cash balance plan that allows them to sock away a substantial amount, exponentially more than you could in a regular plan. But the thing you have to do at the end of the day is be realistic. Be realistic about what your plans are and what the next generation's plans are. And if you are the next generation inheriting land, be realistic about, do I really want to be a landowner? Is that really what I want to do? Or do I want the financial freedom that could come from the value, realizing, unlocking the value of this gift that I'm being given, and then making intentional decisions so things don't happen by accident, so there's not surprises later on?
Your stewardship of the land deserves a plan, and it keeps it in the family for generations to come, or you're realizing it, like Tim said, there's a bunch of different routes that you can go. But start building a true succession plan, blueprint for your operation. Whether it's a farm or it's a business, whatever that is, you can pick up the phone and call the team at Stonebridge Wealth Systems, 866-295-5146. That is 866-295-5146. Or you can always go online at stonebridgeiwm.com.
Hi, I'm Tim Kulhanek with Stonebridge Wealth Systems. You've worked hard and saved for retirement, but how much of it will you actually get to keep? If your savings are in a traditional IRA or 401k, Uncle Sam has a claim on every withdrawal you make. And with tax rates expected to rise in the future, the cost of waiting could be significant. A Roth conversion may help lower your future tax burden. Want to know what your liability could look like? Scan the QR code or visit StonebridgeRothQuiz.com to take our Roth conversion quiz today and see if a conversion makes sense for you.
Thank you so much for listening to the Retirement Compass Radio Show. I'm Mike Bauer, and we got a full house today. Jeff Gove, partner and financial advisor. Tim Kulhanek, co-founder and financial advisor. And Zach Vancas, financial advisor, all at Stonebridge Wealth Systems. And they're located in different places in the state. They have 4 offices, as a matter of fact: Grand Island, Kearney, Omaha, and Lincoln. And guys, I want to jump right into it here. One of the more surprising eye-openers for successful savers, and that's a good thing, successful savers, is that retirement planning doesn't end the day you stop working. It's a whole new challenge. And Zach, I want to start things off with you. Believe it or not, 2 families with exactly the same portfolio size hypothetically can come in and have a completely different lifestyle based entirely on how tax efficient their withdrawal strategy is, which, it kind of sounds weird to me, right? They have the same amount, they should have the same life, but can you help pull back the curtain a little bit on the hidden mathematics of retirement distribution?
Yeah, and unfortunately, it's something that a lot of people don't look into early on. It seems like a lot of people, they get to that magical age of, 65, 67, 62, whatever it is, and then they walk into a financial advisor's office, like Tim made the joke, I think off camera, that, we had a guy come in, 62, already quit, already took Social Security, and wanted to ask Jeff, okay, how'd I do? Well, we've made our bed, but I guess we can find out how we did. So looking ahead is important because, we look at, when it comes to savings, you have 3 different tax buckets. You have taxable, tax deferred, and tax-free. Taxable, this is going to be things like a taxable brokerage or joint account, CDs, bank accounts, etc. Anything that happens in that account every year, interest, dividends, you sell a stock for a profit, that's all taxed every year. Tax deferred, that's where a majority of the people that we meet with have their savings. It's 401ks, it's IRAs, it's the Nebraska Public Employee Retirement Plan, NPERS, 457, 453, all those accounts where you put the money in, you get a deduction, kind of, in that you're kicking that tax can down the road. The money in there gets to grow and grow and grow for the rest of your life, and then one day when you take it out, you'll pay taxes on it later. And then tax-free, that's Roth. So no break to put the money in, it gets to grow tax deferred, and then when you take it out, you don't pay any taxes on the growth. So if you can have 2 people with identical portfolios in size, they each got $500,000. But let's say person A has all of that in a 401k, and then person B has that mix between the 3 different tax buckets. They don't both have $500,000 because every dollar that you have in that tax deferred bucket is not all yours. The government has a piece of it, and they get to vote every year on what percentage that is. Could be 12%, could be 22%, could be 24%, right? Who knows what it's going to be, right? Government gets to vote every year on what the tax laws are. Additionally, it's based on what your other incomes are. Hopefully in retirement, you've got Social Security, you may have a pension, you may have an income annuity, you may get some proceeds off some farm ground, what have you. All of that is going to affect what's your tax rate, and then therefore what percentage of that tax deferred account you get to keep. So having a plan put together ahead of time of when I get to retirement, of these 3 tax buckets, A, where's the money at? And then B, which bucket do I draw from first? Let's say I do have all 3. Which one do I take first? Is it the Roth, because I don't pay any taxes on it? Is it the tax deferred bucket? Is it the tax, or is it a combination of all 3? And that's where sitting down with somebody is so important, because it's hard to give just a blanket answer over the over the radio of, okay, you've got to take, from here, then here, then here, because it's so nuanced to everyone's individual situation.
And that's exactly what the team at Stonebridge Wealth Systems does, is they treat everybody as an individual. Your plan is going to be completely different from the next person's plan. Jeff Gove, Tim Kulhanek, and Zach Vancas from Stonebridge Wealth Systems joining me here on the Retirement Compass radio show. And, Tim, I want to ask you specifically, Zach just brought up that there's taxable, tax-free, and tax-deferred. Threw out a hypothetical that this person has it all in one account. In terms of, and he mentioned there's no universal answer, but something that is universal for everybody is required minimum distributions. Is that something that catches so many people off guard?
More than you'd think. I mean, we've had people who, like Zach, I think it was actually a meeting you had where you told somebody, you informed them. It was an epiphany for them, perhaps, where they had no idea that they had required distributions. What are you talking about? Tell me about that. What happened?
So they had reached the age, and it depends on the year you were born, but if you were born before 1960, it's the year you turn 73, you've been saving all of this money in your 401k, and now you have to take it out. And she had reached the ripe young age of 73, and I informed her, okay, your RMD this year was, I think it's $11,000, if I remember right. She's like, what? It's like, yep, $11,000 has to come out. Well, what if I don't want to take it out? It's not a negotiation with the IRS. Like, it's coming out, and it's taxable to you as income. Well, can I just put it in a Roth and not pay taxes on it? No. Roth conversions are a good idea, and it's something we talk about on the show a lot. But unfortunately, you cannot convert your RMD. That's a prohibited transaction. And so it became this back and forth of, well, how do we deal with the RMD? And unfortunately, there's basically one of two options. Three options. You don't take it, which is
you'll get a penalty.
Yeah, don't do that. Take it. Option two, and really one of the only two options, is you take it, deal with it. Or option three is there's the charity route through what's called a qualified charitable distribution. And so we kind of talked about what that looked like, and then the conversation of, well, how do I not do this in the future comes up, and that's where the Roth conversions come in.
Yeah. But what's crazy to me is that like, to us, and I think sometimes as financial advisors and financial professionals, we take it for granted that how complex the IRS's rules truly are. I mean, it's enough to make your head spin, and they're constantly adding to it. And, sometimes we say that, if you stacked the tax code end to end, it's like 7 feet tall. But that doesn't include all the, court cases, the private letter rulings, and all the different things that really are kind of like the case law side of it that also impact what you can and can't do. And so when you think about rules risk, this is a real risk for retirees today, is not just not understanding the current rules, but understanding that the rules very often can and will change. And so there's decisions that they're going to have to make. And some of it's RMDs, some of it's required distribution related, and the tax implications from that, depending on what their tax bucket configuration looks like. But our job isn't just to help them make the decisions that are right in front of them. Our job is to help them make the decisions that they don't even know are coming around the bend, that they're going to be forced to make at certain key ages, which is why one of the things we've done is we built out a calendar of all those key retirement ages that folks can get just by calling us, and I'll let Mike, you give them the number, but they can find out, well, what are these key ages? Is 59 and a half, is 70 and a half still a thing, or is it 72, 73, 75? What applies to me? You need to be cognizant and aware of these things so you don't end up like the situation Zach just gave, where at that point there was just not much we could do to mitigate the impact that she was going to have. And sometimes people, unfortunately, don't understand that there's RMDs from different account types. You can take RMDs together from your various IRAs. So if you have 72 different IRAs, you can take all of it from one or some from each of them, or any combination thereof. But if you have IRA money, 401k money, and 403b money because you worked at different industries over your career, those cannot be aggregated. You can aggregate the 403bs together, you can aggregate the IRAs together, but they don't cross-pollinate. And the 401ks are just, I don't know, for whatever reason, Congress decided that, no, you can't aggregate those whatsoever with anything, even amongst different 401ks. That's why we exist, to help prevent you from making structural errors. This is a big reason why we exist, I should say. Structural errors that end up costing your family. I mean, Mike, I'm not even joking when I say it could be 6, 7+ figures.
Oh my goodness. Yeah. And you mentioned about not aggregating. It's important for anybody listening now to kind of aggregate your entire retirement plan together. Give the folks at the Retirement Compass a call. I'm sitting down with Jeff Gove, Tim Kulhanek, and Zach Vancas from Stonebridge Wealth Systems. And the solution, a written tax efficiency review, coordinating your income, aggregating your income buckets. You can take action today. Schedule a sit-down for a complimentary strategy session with the team at Stonebridge Wealth Systems. Tim, you mentioned I'm going to toss out the number here. I'll get it 866-295-5146. That's 866-295-5146. You can always go online to stonebridgeiwm.com and set up a meeting in person if you want to at one of the 4 locations, Grand Island, Omaha, Lincoln, or where Jeff Gove is in Kearney. And Jeff, I want to ask you, somebody listening right now is thinking about, I really haven't thought about my withdrawal schedule yet. What do you find in your years and years of experience is the biggest mistake that retirees make with withdrawals?
I think just exactly what we've been talking about. We talked about RMDs, but let's think about the impact of those RMDs. You have to start taking that money out. Let's say it's a big chunk. Let's say you've saved well. And, when you were working, you were told you're going to be in a lower tax bracket when you retire. But let's think through that. Like, what are you really saying? I want to be so broke when I retire. I want to have so little income that I'm not going to pay any tax. That's definitely not the objective, number one. I want you to pay tax to a degree or position yourself so you don't pay tax later. But so let's say you did put that money in that tax deferred account. You think you're going to be in a lower tax bracket when you retire. Let's say your required distribution, you're 73, and let's say it's $60,000 that you have to take out, $50,000. So it's not just tax on that $50,000. Let's say now you're paying tax on 85% of your Social Security. That wasn't factored in. So when you talked to your advisor, you said, I want to withhold taxes. I'm in the 12% tax bracket, so withhold 12%. Then you go to file your tax return. Surprise, you paid enough tax on that distribution, but we didn't account for your Social Security. On top of that, what if now you're paying more for your Medicare? So all of these things have a dramatic impact. So, you're going to be in a lower tax bracket when you retire. A lot of times it doesn't work out that way. We see much higher tax rates when you look at tax impact when you retire. I mean, it's higher than the tax brackets that exist when you look at the tax dollars that you're actually paying on your income.
Yeah, so it's not it's not about how much money you withdraw in retirement. It's about how much money you actually get to keep. And
Right.
if you want to find out about your potential retirement tax exposure, as we talked about in this segment, they have a great website, a tool that they created, a complimentary tax tool calculator at stonebridgetaxbill.com. That's stonebridgetaxbill.com. You can do that on your phone. You can also always use your phone. I don't know, this is crazy, as a phone as well, and give the team at Stonebridge Wealth Systems a call, 866-295-5146. That's 866-295-5146. Set up a complimentary, no obligation first meeting with the team. They have offices in Lincoln, Omaha, Kearney, and Grand Island. We'll be back in just a moment on the Retirement Compass.
A captain can navigate the open ocean. Calm days, stormy nights, they've seen it all. But when the ship reaches the harbor, everything changes. There's narrow passages, shifting tides, and hidden rocks. That's when the harbor master steps aboard, a specialist who knows how to bring you in safely. I'm Tim Kulhanek with Stonebridge Wealth Systems, and we're harbor masters for your retirement, guiding families through life's most important passage. Call the number below to schedule your complimentary retirement strategy session.
Welcome back to the Retirement Compass radio show. I'm Mike Bauer, and I'm sitting down with Jeff Gove, partner and financial advisor, Tim Kulhanek, co-founder and financial advisor, and Zach Vancas, financial advisor. They're all part of the family at Stonebridge Wealth Systems, with offices in Grand Island, Omaha, Kearney, and Lincoln. And Zach, I want to start things off talking about, okay, you're finally at the finish line. It's not really the finish line. For 40 years, your success was measured by a number on a statement. I mean, how many times do you talk to somebody and they love to open up the app and, for their accounts and look at the nice green numbers, things are going up, and they're like me on the days when things are down. I just don't open up the app. But look, an account balance isn't just a high score. That feels great, but you guys have developed a specific process to help people actually turn that hard-earned savings into a usable cash flow.
Yeah, unfortunately, like you said, most people look at retirement planning as just building a number, and it's how much do I have saved, and then one day I think that number's big enough and I'll stop working and I guess it'll work out, You've got
Sounds easy enough.
Easy enough, right? You've got the basic rule. You've heard the 4% rule of, whatever your balance is, take 4% of that a year and you are probably safe. And that's kind of an outdated rule. And there's obviously nuance to that. But unfortunately, people don't put the necessary amount of time, thought, or effort into how do I spend money in retirement? How much should I spend? How much can I spend? Obviously, a lot of what we're trying to avoid in retirement planning is people spending too much and outliving their money. But for a lot of people that we work with, they've spent their entire life, the last 40 years, saving diligently and sacrificing diligently. And then they get to retirement and they can't turn that off. That psychology is just baked into them of, I can't spend, I have to save. And then they, pass away with millions and millions in the bank, never having spent any of it or enjoyed any of it. That's the complete flip side to spending way too much. And that's why it's so important to have a plan put together of, mostly what are your expenses going to be in retirement reasonably, and build in a discretionary budget, right? What do you want to do in retirement? Are you going to travel? Are you going to be a snowbird? Are you going to have hobbies? And build in a budget for that. And if you figure out, okay, my monthly budget's whatever, $10,000 a month, $7,000 a month, and I'm getting $4,000 a month from Social Security, and then I'm getting, a couple $100s a month from some small pension, where do I get the rest of it, right? To get to my income goal of 7,000, or whatever example we're using. That's where we look at, okay, how do we get that out of the nest egg, the retirements? Is it just a withdrawal rate? Are we going to turn on some type of fixed income instrument like an income annuity? Are we, how are we going to set that up? And then if we implement that plan, well, now am I going to be okay? And now how much can I spend? So often, just a couple weeks ago, I had a client come in. She was in her 80s and deathly afraid of running out of money. And she had, probably $2 million and was absolutely mortified. Like, well, what if I spend it all? And at her current income level, current spending rate, she was going to have to spend like a few $100,000 a year for her to blow it. And like I told her, I'm going to be impressed if you blow this. Like, I genuinely impressed if you figure out how to blow this money. But it's just the psychology, because she didn't have a plan before coming in. She didn't know. Like, she didn't know how long that could last reasonably. And that's why you've got to sit down and take the time to put it together.
Yeah, it sounds like, especially in a situation like that. But I'm sure with many, there's a deep anxiety that comes from seeing your retirement balance fluctuate over the years, hopefully accrue, hopefully grow, and then your bills they're fixed. They're still coming due on schedule. So many people retire with that pile of investments like you were kind of outlining there, with no structured income plan to actually replace their salary. You can give the team at Stonebridge Wealth Systems a call today at 866-295-5146. They'll help you out with an engineered, predictable income process, restoring your financial confidence. You don't want to play guessing games with your lifestyle. Get a complimentary written retirement income plan, StonebridgeIWM.com. Set up that first appointment. No obligation, no cost to you at all whatsoever. Or you can always call 866-295-5146. I just mentioned it briefly there, Jeff, but Jeff Gove, partner and founder of Stonebridge Wealth Systems, located there in Kearney. Jeff, investments fluctuate with the market. And a lot of times that's the first thing people do is they look at what the market's doing today. Is it up? Is it down? What happened yesterday? But those mortgage bills, those grocery bills, they're not changing. How do you help people bridge that gap?
Yeah. So, and we've talked about this hundreds of times on the show, but, having an income plan, that's why, the retirement compass, it starts with an income plan. That's where we start. And then we put together a strategy that's going to give you the income that you need to retire the way that you want to. And then we invest the money to figure out, okay, how do we help you accomplish that goal? So, if we have some money in a safety bucket, so maybe that's money in the bank that, the furnace goes out, or car repairs or whatever's going to happen, because things do come up. We have some money set aside for that. And then we have the income bucket. So we're putting enough in this income bucket to give you the income that you need. So that's Social Security. If you're fortunate enough to have a pension, that's going to be there. And then if you need more income on top of that, let's say you needed another couple thousand to fill in that gap between your expenses and your income, we can put some money in an investment that will give you guaranteed income. So then it's not dependent on the market. So if the market goes down, you're not going back to work. It's mailbox money. It's coming every month. You're not taking money out of the market while the market's going down. That's really important as well. And then we have the growth bucket where that allows us to invest that money with confidence because we're not using that to live on. If the market goes down and your account loses value, which will happen, in your retirement years, you're not drawing from that. So it's kind of de-risking your retirement, ensuring your income. But that's, having an income plan set up, that's what it looks like, is putting together a plan that allows you to retire the way that you want to and stay retired. The other thing that is important, I met with a couple earlier this week that they're in their 70s, they're approaching RMD age. There's things that they want to do. They say they've saved really well. They're not taking any money out of their portfolio, but they're concerned about running out of money in the future. So they're very concerned about taking money out because they're those people that was ingrained in them that we aren't spenders, we're savers. This is what we do. But none of us are guaranteed tomorrow. So and I told them, if there are things that you want to do, vacations that you want to take, go do those things. Things you want to do with your grandkids. You've saved well. This is why you saved. So let's go do those things because the day will come that you won't be able to do those things. So don't be a saver until that day where you can't be a spender.
That's Jeff Gove, partner and financial advisor at Stonebridge Wealth Systems. I'm also joined by Zach Vancas, financial advisor, and Tim Kulhanek, co-founder and financial advisor at Stonebridge Wealth Systems. Tim, it's not just about numbers, it's not just about math, too. I'm sure that you guys, at some point in time when you're having these very, very important and significant and substantial conversations, you kind of feel like a psychologist as well, because people are dealing with a lot more than just a financial change.
I actually had people tell me, like, you need to get a couch in your conference room because sometimes I feel like I need to lay down when I talk to you, because it's not uncommon for people to have, it's a lot easier to control people when you tell them negative news than to give them good news. If you give them good news, they think that you're hiding something or that you're trying to what is this guy trying to get me to do? He's telling me positive things. And I don't know what, something in just the way that it's in our brains is how they're designed that we're always looking for the next threat, but it's not uncommon for me to be able to sit down with people and be like, no, like you should retire now. And there's not a mathematical reason why you should continue working and you should start spending your money. I think that there's some, I don't want to stereotype too much, but some places that maybe get a reputation for, they tell me I'm not supposed to spend my money. I feel like I'm guilty, for spending my money. I don't think you should. I think you should have a plan that allows you to spend your money with confidence. And then the question becomes, well, how do we achieve that? Because it's really hard for people to, like Zach said at the beginning, to shift that transition from accumulation to decumulation. And I was looking this up. A recent study between it was BlackRock and the EBRI, which is the Employee Benefits Research Institute. They found that retirees often retain a surprisingly large portion of their nest egg even after many years of retirement. And they found that retirees still had roughly 80% of their pre-retirement savings after nearly 2 decades, 20 years of retirement. And they still have on average 20% of what they started with. And then they closed the study by saying retirees tend to spend only about 1/2 of what they could safely withdraw from their investment portfolios. So what's the solution? Part of it is meeting with somebody who you have an ally in your corner, somebody who's landed a plane before. If I'm going down the ramp, like I fly out of Lincoln all the time, and usually I peer in to see who's flying the plane, and sometimes they're like, these like 30 to 40-year-old looking guys and gals. I'm like, okay, they've been on the block a few times at least. And then sometimes it's like a 12-year-old. I'm like, I'm pretty sure he just got was 6th grade graduation fun. Like, why is he flying? What is he doing up there? You want to find somebody who's landed the plane before. And we have a whole team of advisors who have done that. We know the tools that are needed to get the job done. When you come here, we're not trying to fit you to a preset, canned solution. It's, I want to sit down with you, ask you questions, get to know you, know what's important to you, what roadblocks have you faced when it comes to planning for your retirement, and then custom design something that truly fits your needs, wants, and desires so you can spend time where that intersection of those two circles, right, between, spending your money would be the people you love, the experiences that you've always wanted to achieve and experience. Do that with the people you love. That's where I want you to spend that money and spend it confidently. And we're going to help design a plan that's going to let you do exactly that.
And that's exactly what the team at Stonebridge Wealth Systems does, is help you find that confidence, build that confidence, grow that confidence in your retirement. Stonebridge Wealth Systems can be reached at 866-295-5146. If you're ready to remove guesswork, eliminate the friction, take the next step, pick up the phone right now and get a complimentary written plan, 866-295-5146. And if you prefer to start on the old interwebs, you can access all the calculators, quizzes, and planning resources we touched on today at stonebridgeiwm.com. We got a busy show today for Tim, Zach, and Jeff, and the dedicated team at all 4 Stonebridge Wealth Systems locations. Thank you so much for joining us on the Retirement Compass Show. We'll be back next week.